Hello, everyone. Welcome back to another episode of Signal or Noise. This is episode 45. Charlie Bilello here, and with me, as always, Peter Mallouk. Peter, just one topic for us today. No noise, all signal. This is what I like to call the price of admission. It's the most important thing for an investor to understand, and hopefully this will be timeless for people. Anytime there's a correction or pullback, they can refer to this. Obviously, we're in the midst of one today. So let's start out first by talking about the price of admission. And this is a chart we always show, Peter. Stocks, really, for the long run, illustrating stocks have done about 10% per year historically. Bonds, 4.5%, cash, 3.3%. You can see after inflation, there's no comparison. Stocks close to 7% per year since 1928 versus 1.5% for bonds and 0.3% for cash. So we like to update this every year and illustrate this to investors because you have to be a long-term investor. You should be thinking about the long term. But the big question, Peter, of course, is always, well, how? Why? Why am I getting this higher return from stocks over the long run? And the answer is, of course, risk.
Yeah, I mean, obviously, we all know the least risky thing on planet Earth is U.S. Treasury, right? So we can put our money in the bank, we can get very close to nothing on it, and we know over the short run we'll get close to nothing. Over the long run, we'll get close to nothing, and we're going to get a low return, but with a heck of a lot of certainty. Now we could go loan money to corporations or the government or the county that we live in, whether it's a municipal bond or corporate bond, and we're going to get a little bit better return. And we loan the money and we say, hey, you can borrow this money for 1 year, 5 years, 10 years, and you pay me interest. But there's a jump in return for that. Well, there's a big jump in return, as your chart shows, from bonds to stocks. Why does that big jump? Why is that there? Well, it wouldn't be there if the risk was exactly the same as bonds, right? If we were going to buy a stock and there was going to be very little volatility, we had a guaranteed rate of return, the stock market wouldn't have a lot of return because everyone would be in it. The way the stock market lures investment is it says, look, you're an owner of this company. You're a part owner of the company. And that means the value of your ownership stake of this company is going to do what businesses do. It's going to go up and down a lot and very frequently. But because you're going to tolerate that, because you can put up with that if you're a great investor, you're going to get a better return, a better expected return. And so the reason that stocks do twice as well as bonds over long periods of time is it's the price of admission. It's the price you pay. The volatility is the price that the investor pays. And investors should be excited about that volatility because without it, expected returns would be lower.
Right. No risk, no reward. But there's many different ways to define risk, Peter. What's your personal way of looking at it? Is it volatility? So just simply the swings up and down? Is it drawdowns, which is the amount you're off an all-time high, which is happening very frequently if you're an equity investor? Or is it this idea of permanent loss, like
Right.
crystallizing that loss?
Yeah, I
Everyone
mean,
has a different, what's your view on risk?
that's a great distinction here. So there are some things you invest in them, there's a risk of total loss. So a lot of different cryptocurrencies, we know that 99% of them already have gone to zero, risk of total loss. NFTs, risk of total loss, and even individual stocks. Companies go bankrupt all the time, total loss. Enron, a famous example, Lehman Brothers, but there are hundreds and hundreds of these examples, and they happen every year. And then there's risk of volatility, just what we're experiencing now. Markets go down temporarily, and then at some point in the future, we don't know when it is, they recover. So if you're, say, an index-based investor, if you own the S&P 500, which represents large U.S. companies, well, the S&P 500 is not going to zero. We've had 100 plus corrections. They've all ended the same way with a total recovery and then on to new highs. We've had dozens of bear markets where the market goes down 20% or more, and then we have the market recover. So you got a broad-based portfolio, you're talking about volatility risk. That's a very different, very, very different than risk of total loss, and should give an investor that's diversified comfort that they're going to get through these corrections.
Yeah, so it's really about your time frame as an investor. And if you're a very short-term investor, which you shouldn't be, but trying to jump in and out and your time frame is days or weeks, then you should be concerned about the up and down volatility. But as you lengthen that horizon, you have a 10 plus year time horizon, well, you should be really focused on that permanent loss. And we'll talk about ways to think about corrections, and really not interrupting compounding is really the big lesson that we'll talk about in the end for investors. As you said, if you're diversified, you're minimizing that risk of permanent loss. And so, really, it's about getting through these periods of higher volatility. But in terms of thinking about risk, what investors often think about, Peter, is when they started out in their careers or when they first started investing. And really, they jump to that example. And for me, it was probably the 2008 financial crisis is most relevant. But for everyone, it's going to be different. Obviously, if you grew up during the Depression, you're always going to be remember that, the 1929 crash, which set it off. If you were growing up in the 1970s, you had that high inflationary period. You had the 50% bear market in 73, 74. Then, of course, the 80s, the 87 crash. You had the dot-com bubble peak in 2000, which lasted a few years in terms of that bear market. And then most recently, the newest generation is probably thinking about the 2020 COVID crash, even though it was very short-lived. It was very panic-inducing at the time. For you, which one of these examples really is the one that you come back to was formative for you?
Well, I've got to say, I go back to all of these for different reasons. So I've read, books about all of these. Of course, I lived very directly through 2008. Right, my career was very, very early for the ones that happened in 2000. Really back to back. You had 9/11 of the tech bubble, just boom, boom. And in many ways, that was worse than '08 because you had people, go backwards almost 50%. Then there's a recovery. Then you go backwards almost 50% again. It was exhausting. Whereas
Yeah.
'08 was just one really like big punch in the face that went on for 6 months. Then you had a recovery from there. So these are all very, very different. But as a student of financial history, they all come to life with me in very, very different ways. And I can hear it from my clients. So you had clients whose parents were really involved, aware of the Great Depression. They're very acutely aware of this. And if so many of our clients were alive through the hyperinflation of the '70s or were very active during the '87 crash, and they really hone in on that, as you said, that first big event that they had of like, hey, don't tell me A, B, C can't happen. I know it can, right? All of
Yeah.
these, what's interesting about these bear markets is they all had a very different, all of them, extremely different cause, just kind of out of the blue, no one talking about it. Very big catalyst that created very different outcomes, but all of them had the same ending: total recovery, market on to new highs. Question is, what was the ride like to get there?
Absolutely. But the interesting thing, Peter, is if you zoom out any time period, it almost seems like it's an easy ride. Here I'm showing you, it's actually this past weekend was the 16th anniversary of that March 2009 low. It's hard to believe it's been 16 years, but if you look at this chart of the S&P's total return since then, you could make the case, gosh, what was so hard about this? You returned over 1,000% since then, 16.6% annualized, well above the historical average, which we talked about, which is 10%. And what an investor is missing, obviously, here, Peter, is all the details along the way, all of those bear markets, corrections, the intra-year decline. So, what I like to say is the reality is risk is always present, even if you can't see it. And as you've talked about many times, every year you're going to experience as an investor some type of pain, although the magnitude is going to be different.
Yeah, and so I gotta say, right now, it's been a long, long time since we've experienced pain. I mean, I can't remember the last correction. I know it's been over 15 months, maybe longer. Charlie, do you know how long it's been?
Yeah, you got to go back to 2023 for a 10%
I
pullback.
mean, that's
We're just short of it. You and I recorded that show last August where we were just below 10% for the S&P 500.
yeah, I
So
mean, just
definitely been a
crazy.
while.
Yeah, much, much longer than normal. Which, depending on how far back in time you want to go, is 10 to 15 months. With the average corrections 14%, we're not even to an average correction yet at the time of this recording. So it's very, very normal to have this kind of volatility.
Yeah, which brings us to this chart here. As you said, 14% is the average drawdown. I think that would surprise a lot of people. This is looking at a closing basis, and so far this year feels like a lot. We're getting a lot of questions from people. And the answer is just really look at this historically. These types of drawdowns have not prevented the market from going higher. And as we started out by saying, it's the exact reason why you're getting that return. So since 1950, the average drawdown the average year has been around 14%. And in spite of that, or perhaps because of that, you've actually returned over 11% since 1950. So pretty incredible there to see that.
Yeah, I mean, this is an incredible chart. I mean, in terms of just really putting in perspective how common it is, and how quickly the market recovers from these corrections.
And oftentimes, as we'll talk about later, you don't even remember them or
Yeah.
what the reason was, and all of that stuff. Like so, today, all the tariffs and trade wars, and we're going to talk a little bit about that, is the big focus in the news. But when we recover from this, whenever that is, years from now, it'll probably be long forgotten. But in terms of pullbacks, it's not just limited, of course, to that intra-year decline, right? Sometimes these things go on for longer, Peter. And in terms of bear markets, if you're an investor for 30, 40 years, you're going to see many of these simply because just looking at historically, we see a 20% decline historically every 4 years on average.
Yeah, and I think that bear markets really sometimes they happen so fast we don't even remember them. I mean, the last time we had a tariff war, I mean, it only went on for a few weeks. Market went down 19.6% in just a couple of weeks. Of course, the ones that really stand out are the 30% more. COVID, 9/11, tech bubble, 08, 09. They tend to have more substance behind what caused them. But as all bear markets, same conclusion, right? We figure out our way through the storm eventually.
Yeah, and you're going to be hit with them. You should expect them. And as you said, there's no uniformity here in terms of the magnitude, the duration. Some of them were associated with recessions. The last one, Peter, as we know, was not, although many people thought we were in a recession at that time. It didn't end up being the case. So you can have stock market declines like we're seeing today. A lot of people ask, is this because we're going to recession? Maybe, but there's many examples like 2022, 2018, 2011 where you had 20% declines and there wasn't an economic underpinning.
That's right. So not every bear market comes with a great story, and also the market's dynamic. If you think about what's going on today, we have changes probably coming with corporate taxes, significant changes probably coming around regulation. We're going to have a total redirection of what's happening with Russia and Ukraine, a total redirection of what's happening with Israel and the Palestinians, and that's on top of tariffs and theoretically very pro-business posture. And you put all this stuff together, and you sprinkle in the immigration issues and everything else. You can't really say, well, what's causing today's correction? Is it just tariffs, or is it uncertainty, or is it a foreign policy? I mean, we there are a lot of things happening at once, and so in retrospect, we always go put a category of what really drove these things, but it's never usually not quite that simple.
Right. But last year, for most investors, it seemed pretty simple. It seemed like risk was almost eradicated. We have 57 all-time highs that we talked about many times on the show, fifth most of any year in history. Very smooth ride higher for most of the year. And the market was higher right out of the gate and it really never looked back. It exceeded all of the analyst projections. But as we know, this was kind of an outlier. We talked about it historically. You're more likely to have a year like we're seeing today, currently, than a year like 2024. And it's always good to provide that backdrop. What happened coming into this year? We had two massive, massive years for the S&P 500, up over 25% in both of those years. We're only in March here. There's a lot of the year to go. But this type of volatility, very, very normal for investors to experience. And what we learned so far this year is no, of course not. Risk has not been eradicated. And as you said, the reasons always change. The media loves to assign a reason, Peter, and it's pretty easy when there's so much noise going on. You just pick whatever the biggest headline is, and that's been tariff fears and then slowdowns. And usually, when you get a reasonably sized stock market decline, that slowdown fear starts to creep into this. But Do you think this is different in any way than what we saw back in 2018? As you said, there was a relatively big correction being blamed on the same thing today, tariffs, trade wars, and we saw a few pullbacks in 2019 as well, which was 2019 was a very strong year for the equity markets. But tariffs and trade wars were big headlines back then. Do you see any differences today versus back then, where investors maybe should be concerned today, where they shouldn't have been back then? Any differences in your mind?
I think the lead thing driving this is the tariff issue. But I mean, everybody knows, no matter how you feel about this issue, it's one thing to go into a correction or bear market where you don't control things like COVID. Like, is everyone going to die? Is everyone not going to die? Are we going to go back outside? When is this going to happen? Like, there was a period of time where nobody knew the answer to those questions, right? Or certainly the majority didn't know the answer to those questions. After 9/11, like, is there going to be another terrorist event? How long is it going to take Wall Street to stabilize? Will people be comfortable going back to crowded places for a while? We didn't know the answer to those things for a while. Here, like, look, I mean, if there was a real big problem, they could just stop the tariffs, right? This is a self-inflicted short-term damage to, according to President Trump, try to get a different outcome down the road. Whether that happens or not, everyone can debate. But this is the kind of thing in control, right? And so to me, this is even if this became a bear market, would be one of the least stressful bear markets of my lifetime, right? Because you when you have a dynamic that is partially self-induced, it's a lot easier to resolve, right? If there's a miscalculation, you can correct. We also have interest rates higher than normal. And so if we really found ourselves in a recession, the Fed can lower rates, which historically really does motivate people to buy things and help us get out of a recession. There was a long period of time following 0809 where the economy was very vulnerable and rates were already at rock bottom. There were no bullets in the Fed's gun. That's very different today. So I view this as probably, if we're going to have a recession, this would be the healthiest one in a long time. If we're going to have an actual bear market, it would probably be one of the mildest. Now, that's speaking about what we know today, right? Of course, again, the economy's dynamic. Things can change. Terrorist events, wars, dramatic changes with policy. Anything can happen at any time, no matter where the markets sit, no matter who's in office. But as things sit today, I mean, this is something that I think the markets understand what's happening, pricing it in over the short run. But there are a lot of controls here to help us on the other side if needed.
Right. To me, when you look at it, you can't look at it in a vacuum. You have to look at it in terms of what happened before, where were valuations, where were expectations coming into the year. And for many months, we were talking about all of those factors being on, okay, maybe we have excessive optimism. And now we're just seeing the natural pullback from that, and we're being blamed on tariffs. Perhaps that's the case. Perhaps it's not that it's going to happen. But ultimately, Peter, you need to believe that these tariffs will be permanent. They will be deep. They will be punitary. They will be, they were punitive. They will be irrationally in place to hurt the U.S. economy and to hurt U.S. corporate earnings. It's hard for me to believe, even what we've seen the last month in terms of one day it's on, the next day it's off. It's hard to believe that the markets are pricing in a long-term impact of that, just given the knowledge that it's so uncertain what's actually going to happen. And we don't ultimately know. Some of this might actually be a good thing in terms of equaling the playing field. And we know that many of these countries have high tariffs on the US, and there's a big debate. Okay, should we retaliate, be reciprocal? So it's a long, big, and complicated issue. But the way I think about it for an investor is it's not a reason to interrupt your compounding. If you have 20, 30 years, no one's going to be talking about this issue as an investor. 20, 30 years from now, the market is going to be higher because earnings are going to be higher regardless of what happens with tariffs. So we just come back to that Charlie Munger quote: don't interrupt it unnecessarily. All these corrections, Peter, since March 2009, they seemed important. They seemed like a good reason to interrupt it. But then, as we learned, sometimes a few days, sometimes a few months. If you look at the 2022 one, it lasted for most of that year. But ultimately, all of them in hindsight were deemed to be unnecessarily, if you didn't need that money then, if you had a long-term horizon, you shouldn't have done anything.
Yeah, don't let the market scare you out. I really look at it like you can tell when someone's become a good investor when they are unfazed. They hold through everything, but you go from good to great when you actually are excited about corrections and bear markets because you know that this is why you get the excess return and that will likely continue. And you also have opportunities that may present themselves. So the bad investor panics, goes sells some things, sells and goes to cash. The good investor holds, and the great investor and stays calm. The great investor actually really looks forward to these as a reminder of why they're going to get the outperformance, and because in some cases a bigger opportunity presents itself.
Yeah, I still remember early 2023 when you were telling people, look, if you have the ability to do so, take advantage of this pullback here. You could front load your 401k contributions. And at the time, people probably said, oh, this is crazy. We're going into a recession. There's inflation. Not that you knew what the outcome was going to be, but you knew that stocks were on sale. And in history has taught us when stocks are on sale, it's a better time to buy if you have a long horizon as an investor. So we come back to this road to wealth, Peter. This is really the decision all investors have to make. Do I want that straight line, which is cash, as you said, treasury bills? Nothing could be safer. You're still earning 4% for now on those treasury bills, and it seems hard to resist, right? It's that straight line. You know what you're going to get, and you look at that road for stocks, and it's long and it's winding. And why should they choose that long and winding road for stocks?
Much
Why should
better,
they be an owner?
much better destination. Much better destination.
Then that's the only reason. So you come back to the payoff here. And in the short run, the payoff could be nothing or it could be negative, right? We're only in March now, but the S&P is down a few percent. And cash obviously is up, right? Because it only goes up. But that shouldn't be your horizon if you're a stock market investor. You have to be looking out in the long term. If we go out to 10 years, you're looking at 100,000 investment turning into over 300,000 for the stock market versus 145,000 for cash. And you go out to 30 years, which is going to be the investing horizon for most people if they start working and contributing to their 401k or IRA when they're 25. Most people are going to have well over a 30-year horizon. And just look at that differential there, Peter. 2.5 million for an investment in US stocks versus 392,000 for cash. So really no comparison whatsoever. That's the why you pay that price of admission, is to get this long-term reward.
Yeah, and the longer it goes, the more dramatic it gets. I think this is what's hard for people to comprehend is in the short run, difference isn't that significant. But if you just don't interrupt the compounding, particularly in the corrections and bear markets, you will get this big payoff over time.
Yeah, and one last point on that, because this is a question we often get, and the right answer is we don't know. But the question is, well, how deep is this going to be? So we're down 7 to 8% right now. Is it going to be 10%? Is it going to be 20%? Is it going to be 30%? You don't have that answer. I don't have the answer. No one going on CNBC, they might tell you they have the answer. No one knows. And that's okay, because that uncertainty is precisely the reason why you're getting this higher return as an equity investor over time. So embrace that uncertainty. Don't listen to anyone who tells you they know what's going to happen next, and understand as an investor that the price of admission is this risk of decline and the reward you can see in this chart. Okay, Peter, hopefully this will be a resource for people every time. There's going to be many more corrections this year, next year. As an investor, you're going to have bear markets, you're going to have recessions, but hopefully this will help you keep a historical context and stay optimistic. Everything that's bad today, the bad news, it's going to be brighter in the future, regardless of what happens 20 years from now, 30 years from now. Things are going to be much better than today. So if you're watching this, you're worried about your portfolio, worried about this correction, or you're just looking for a second look on your portfolio, your financial plan, reach out to us today at Creative Planning. We can help with all of that and much more. Go to creativeplanning.com/Charlie. Get a free wealth path analysis from us at Creative Planning. We're in all 50 states and we're international as well. So we likely have a location right near you, over 350 billion in assets under management and advisement. And we're here to help. So reach out today, creativeplanning.com/Charlie. Thanks everyone for watching Signal or Noise. If you're watching this on YouTube, hit that subscribe button for more content, and we'll see you next time on the next episode of Signal or Noise.